I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. In this week's video, we discussed last week's TPG earnings result and the market reaction. TPG's results to 30 June 2016 provided the market with its first full 6-month period snapshot of the company, including the iiNet acquisition. While the realisation of cost synergies in iiNet was pleasing, the repositioning of the product offering relative to the TPG brand had a more negative impact on net broadband subscriber numbers than expected in the 6 months to June. As a result, overall broadband subscriber numbers grew just 1.4% in the 6 months to June across both the TPG and iiNet brand portfolios. Corporate revenue was also weaker than expected, but this was mainly due to the rationalisation of lower margin contracts. The earnings contribution from the corporate division still met expectations despite the weaker than expected revenue result. Of greatest concern for the market was the earnings guidance provided by management. While we had expected the migration of customers from ADSL to the NBN network to negatively impact TPG's gross profit per subscriber, management flagged a more significant impact than previously expected. TPG indicated that there is downside risk to the already lower dollar margins on NBN products due to competition. Broadband customers have traditionally been sticky with churn rates low for the industry. Churn rates refer to the number of subscribers that change providers in a given period. The consumer's reticence to change providers has protected Telstra's customer base from price-based competition from other retail service providers like TPG and Focus. However, the rollout of the NBN and the decommissioning of the copper phone network over the next few years presents a once-in-a-lifetime opportunity for customer movement before a reversion to their normal level of resistance to change. This is likely to result in heightened price competition in the market as the rate of household migration from ADSL to the NBN accelerates from almost 500,000 households in 2016 to over 1 million in fiscal 17 and a peak of 2.25 million households in fiscal 19. Telstra is expected to be extremely focused on retaining its dominant share of the broadband market through this process. As a result, margin pressure is likely to intensify over the next few years as Telstra fights to retain its market position and other retail service providers look to build share as customers assess their internet options under a government-forced product change. Longer term, margins are likely to recover to some degree as churn rates fall. However, margins and earnings are likely to remain under heightened pressure across the industry over the next few years. We continue to hold TPG in the domestic portfolios due to the long-term prospects for growth, but acknowledge the medium-term outlook is likely to remain difficult and volatile on the back of increased competitive intensity in the market. That's it for this week. We'll be back next week. In the meantime, you can follow us at montinvest.com and on Twitter and LinkedIn.